I lost 109 units in 2009, not because of the market, not because of a bad deal. I lost everything because of three invisible mistakes. And if you're managing more than 5 doors right now, you're probably making at least two of them. On the surface, everything looked successful. Strong portfolio growth, multiple markets, climbing equity positions. But underneath, no real systems. Just momentum and market timing masking fundamental fragility. Then one market shift hit. The collapse wasn't gradual, it was total. 109 units gone in what felt like weeks. That's how I learned what actually prevents collapse. And what I'm about to show you, most investors never see until it's too late. Most operators focus on acquisition velocity. The real operators focus on infrastructure that survives market cycles. There are three systems that prevent collapse. Cash flow systems, revenue streams that function independent of closing timelines. Predictable, diversified, systematic income that creates breathing room when deals stall. Legal armor, every contract reviewed without hesitation. Protection layers built before problems surface. No $300 per hour decision paralysis holding you back from clarity. AI systems, repetitive tasks automated completely, your attention freed for strategy and relationships. Operations that scale without adding headcount chaos. Miss one pillar, the foundation crumbles. These aren't optional upgrades. They're the difference between scaling and collapsing. You're one bad clause, one cash flow shift, one stall deal away from everything shaking. The gap between appearing successful and being structurally sound is measured in single points of failure. One overlooked contract term, one revenue stream drying up, one market correction exposing what was never actually stable. If any single point fails, the whole structure shakes. Your portfolio looks impressive on paper. Units under management, deals in motion, capital partners engaged. But the internal reality tells a different story. Cash flow fluctuates wildly month to month, dependent entirely on closing schedules. You tell yourself the next closing will fix it, more often than you admit publicly. Unknown number calls trigger immediate dread instead of curiosity. You're constantly reacting, rarely building. The gap between external perception and internal experience creates constant stress. You're running faster just to maintain the appearance of stability. If this sounds familiar, keep watching. Here's the pattern you need to see. 3 months ago. Once this deal closes, I'll build proper systems. Last month. Just need to get through this closing, then I'll organize everything. This week. After this contract is signed, I'll finally set up infrastructure. Reality, same volatility. Still reacting, nothing changed. 6 months pass. The closings happen. The revenue hits. But the fundamental structure remains reactive, not systematic. The after this deal promise becomes a perpetual delay mechanism, always one closing away from addressing what actually needs to be fixed. Before we go further, you need to understand something. This isn't your fault. The real estate education ecosystem teaches acquisition mechanics and capital stacking. Nobody teaches the boring infrastructure that actually prevents collapse. What you're told, Chase more units, raise more capital, scale faster. Velocity equals success. The metrics that look good in LinkedIn posts. What's never shown, the boring infrastructure, the systems running underneath, the legal reviews, the cash flow diversification, the automation protocols. What you don't see, the operators you admire have teams and systems invisible from the outside. Their portfolio didn't scale their workload, their infrastructure did. Investors rarely go broke from a bad deal. The collapse narratives always focus on the wrong villain. It's never the single failed acquisition that destroys portfolios. It's the invisible structural weaknesses that a single deal simply exposes. Cash flow gaps, revenue dependency on closing schedules, no buffer systems, one delayed closing cascades into missed obligations across the portfolio. Legal exposure, unreviewed contracts, assumed protections that don't exist, liabilities invisible until triggered, clause language that seems standard until it isn't. Scaling chaos, growth outpacing systems. More units mean more manual work, increasing complexity without increasing infrastructure. Burnout disguised as ambition. These are collapse triggers, not the market, not the deal. The infrastructure gaps that make you vulnerable when pressure arrives. What if, 90 days from now, you open your banking app and see predictable revenue, regardless of whether a closing stalled or a contract fell through? You send contracts for review without calculating hourly costs, or delaying decisions because legal clarity is just part of your operating rhythm. Your portfolio is growing while your personal workload decreases, because repetitive tasks simply run without your constant attention. This isn't theoretical. It's a natural result of infrastructure built correctly, systems that create leverage instead of dependency. The question isn't whether this is possible, it's whether you'll be saying, after this deal, 6 months from now. Let me show you exactly how I learned this lesson. The path from 2003 to 2009 looked like success from every external angle. Rapid growth, multiple markets, expanding portfolio, capital flowing. 2003 started scaling aggressively. Velocity felt like validation. Every deal confirmed the approach. 2005, portfolio expanding fast. Complexity increasing faster. Systems always after the next closing. 2009, market shift exposed every infrastructure gap simultaneously. 109 units gone. Lesson learned in the most expensive way possible. What looked like a bad market was actually fragility meeting pressure. The collapse taught me what I should have built during the growth phase. Now you get to learn it differently. 2 duplexes in a single foundation phase. 24 units first expansion. 32 units gaining momentum. 36 units accelerating growth. 109 doors peak portfolio. Every investor dreams of this trajectory. 2 duplexes transformed into a portfolio spanning over 109 doors in what felt like a calculated climb. The deals kept coming, the units kept filling. On paper, the empire was expanding exactly as planned. But beneath the surface of every acquisition, a dangerous truth was taking root. Growth was happening faster than the infrastructure to support it. The foundation wasn't reinforced. Systems weren't installed. Stability wasn't engineered. What looked like momentum was actually velocity without direction, acceleration without brakes. When you're growing, problems feel temporary. Cash flow volatility, Monthly swings of tens of thousands become normalized. 1 month felt flush. The next felt suffocating. No buffer existed to absorb the turbulence. Every delay rippled through the entire operation. Legal blindness. Contracts were skimmed, not reviewed. Attorney fees felt too expensive compared to closing fast. Risk was invisible until it wasn't. Small clauses carried massive consequences that wouldn't surface until years later. Single point of failure. Everything bottlenecked through one person, me. Every decision, every approval, every fire. If I was unavailable for 48 hours, the entire machine ground to a halt. There was no system, just hustle. You tell yourself you'll fix it later, once things stabilize. But growth doesn't create stability, it amplifies fragility. The faster you scale, the louder the cracks echo. And then it happens. Copper got stolen. Asked the bank for more borrowed money and time. The bank called the note. It was the straw that broke the camel's back. It wasn't a catastrophic failure, no lawsuit, no natural disaster, no fraud. Cash flow issues and no reserve. Too many leverage tricks strung together in a shaky row affecting the whole of my business. No firewalls, no buffers. But when your entire operation is balanced on assumption and nothing goes wrong, one small normal thing going wrong can be that straw that breaks the camel's back. The cash flow gap widened, payments stacked, vendors waited, contractors walked off. Suddenly the entire portfolio was held together by willpower and credit cards. The system didn't break because of delays. It broke because there was no system, just a fragile chain of assumptions that required perfection to function. One disruption, that's all it took. The collapse forced a brutal reckoning. Every investor blames the deal that broke them, the bad tenant, the delayed closing, the surprise expense. But deals don't destroy businesses. Fragility does. The real failure wasn't in the investment decision. It was in the architecture beneath it. No cash flow buffer to absorb shocks. No legal review to prevent exposure. No operational leverage to remove bottlenecks. The business was optimized for speed, not survival. And when survival became the requirement, the infrastructure wasn't there. This wasn't a lesson about avoiding risk. It was a lesson about engineering resilience before risk finds you. Because in real estate, risk always finds you. It's just a question of whether your foundation can hold when it does. I spent years reverse engineering what should have been installed first. 1. Cash flow buffer. A systematic reserve protocol that absorbs volatility without panic. Not a static savings account, but a dynamic engine designed to stabilize monthly swings and prevent cascading failures. 2. Legal armor, proactive contract review and entity structuring installed before deals close. Risk mitigation embedded into every transaction, not bolted on after exposure is discovered. 3. System leverage, operational infrastructure that removes the owner as the bottleneck, processes, automation, and delegation frameworks that allow the business to function without constant intervention. The rebuild wasn't about doing more deals. It was about installing the systems that make deals sustainable. Every conversation with attorneys, accountants, and operators circled back to the same conclusion. The infrastructure investors skip in the beginning is the exact infrastructure that determines whether they survive the middle. And then I started seeing the same pattern everywhere. Late rent kills a whole month. One tenant's delay triggers a cash flow crisis that ripples across the portfolio. No buffer exists to absorb the gap, so the entire operation enters survival mode until the next payment cycle. $300 an hour fee prevents contract review. Attorney fees feel expensive until a single clause costs $30,000. Investors skip legal review to save a few $100s and then spend years dealing with the consequences of what they didn't read. Owner is the system until life happens. Every decision flows through the operator. Every approval requires their attention. The business doesn't scale. It just adds more hours to the owner's day until something breaks or someone burns out. This isn't an isolated story. It's the default trajectory for operators who prioritize acquisition over architecture. The pattern repeats across markets, asset classes, and experience levels. Here's what most investors don't understand. You're not competing with other investors. You're fighting volatility. Every investor enters the market believing the competition is other buyers. Better underwriting, faster closings, stronger relationships. The focus is external, outbid, outperform, outmaneuver. But the real opponent isn't across the table. It's embedded in the business itself. Cash flow swings, operational bottlenecks, legal exposure, market shifts, tenant defaults, contractor delays. These aren't anomalies, they're the baseline condition of real estate investment. The investors who survive aren't the ones who avoid disruption. They're the ones who engineer systems resilient enough to absorb it. Stability isn't a market condition, it's an infrastructure decision. And most operators don't realize they're on the wrong battlefield until volatility wins. If one disruption can still choke your business, you are not stable yet. Stability isn't measured by how well things run when everything goes right. It's measured by how long the business survives when something goes wrong. If one disruption, a delayed closing, a vacancy spike, a contractor disappearing, can threaten the operation, the foundation is still fragile. Growth under those conditions isn't progress, it's risk compounding. Most investors confuse momentum with stability. Deals closing feels like success. Units filling feels like traction. But if the infrastructure beneath those deals can't absorb a single shock without cascading failures, the portfolio is still one disruption away from collapse. The question isn't whether disruption will come, it's whether your systems can hold when it does. You don't build higher floors on wet concrete. Every operator wants to scale. More doors, more cash flow, more equity. The market rewards size, and investors are conditioned to chase growth as the primary metric of success. But scale without stability is velocity without control. Every new unit compounds the fragility of the existing infrastructure. Cash flow volatility multiplies. Operational bottlenecks intensify. Legal exposure expands. The business grows faster than the system supporting it. The result isn't a stronger portfolio, it's a larger house of cards. More deals don't solve the underlying problem, they amplify it. Stability must be installed first, not as a luxury reserved for later stages, but as the foundation required before the first expansion. Growth is the reward for stability, not the path to it. That's why the profit shield growth system exists. 3 interlocking systems, not ideas, installed in 90 days. Cash flow engine, systematic buffer protocol that absorbs monthly volatility and prevents cascading failures. Legal fortress, proactive contract review and entity structuring installed before exposure surfaces. Operator leverage system, infrastructure that removes the owner as the bottleneck and enables true delegation. This isn't theory, it's the operational architecture that should have been installed before the first deal closed. The systems that prevent collapse aren't aspirational, they're engineered, documented, and deployable. The profit shield is the foundation most investors skip, the infrastructure that transforms fragile momentum into sustainable growth, the stabilizer that allows scale without compounding risk. The shift from reactive chaos to commanded stability isn't luck, it's engineered infrastructure. Before, cash swings force reactive decisions and drain mental bandwidth every single month. Legal hesitation delays critical deals and creates exposure in every transaction you touch. Owner bottleneck limits growth velocity while trapping you in operational quicksand. After, buffer active provides breathing room and predictable runway for strategic deployment. Contracts reviewed by professionals eliminate blind spots and protect every angle before signing. AI running ops handles follow-up, tracking, and execution while you focus on expansion. The shift from reactive chaos to commanded stability isn't luck, it's engineered infrastructure. When volatility becomes predictability, you stop managing fires and start building empires. The operators who control their foundation control their trajectory. Stability is engineered, not wished for. Week 1 to 4, we stabilize, identify bleeding points, install legal protection, and establish cash buffer pipeline. Foundation gets locked. Week 5 to 8, systemize, deploy AI tracking, automate follow-up sequences, and remove owner dependency from daily operations. Week 9 to 12, expand. Scale with confidence, knowing systems hold under pressure. Growth becomes sustainable, not reckless. This is the 90-day arc that transforms chaotic portfolios into controlled machines. Each phase builds on the last. By week 12, you're operating from a position of strength rather than scrambling to contain damage. Stability isn't the end game, it's the launch pad. You don't wait 90 days to see movement. Transformation begins immediately. The first 30 days deliver tangible infrastructure changes that compound throughout the entire program. You'll feel the shift before the calendar turns. Legal Shield engaged week 1. Professional contract review starts on day 1, catching dangerous clauses before they become expensive lessons. Cash buffer pipeline starts early. Immediate identification of cash leaks and deployment of retention strategies to build financial cushion. AI tracking plus follow-up live in month 1. Automated systems begin executing repetitive operations, freeing bandwidth for high-leverage decisions. Momentum builds from day 1. You're not waiting for some distant finish line to experience relief. The infrastructure starts working for you immediately, while a full system takes shape over 90 days. One bad clause can erase a year of work. Every day without proper legal infrastructure exposes you to catastrophic risk. A single missed indemnification clause, an overlooked liability transfer, or an unreviewed guarantee can detonate your entire operation. The cost isn't theoretical, it's compounding with every unsigned contract. Volatility compounds, so does protection. Cash flow instability doesn't stay contained. It bleeds into decision quality, deal velocity, and team morale. The longer you operate without buffers and systems, the more expensive the eventual correction becomes. Installing armor before you need it is always cheaper than rebuilding after collapse. The operators who delay protection tell themselves they'll implement it after the next deal closes. But the next deal brings new chaos. The cycle never breaks until you force the break. Time costs more than money when your foundation is compromised. The masses chase doors. The disciplined build armor first. There's a reason certain portfolios withstand market shifts while others implode at the first shock. The difference isn't luck or timing. It's deliberate infrastructure installed before pressure arrives. Serious operators understand that protection precedes expansion. The crowd obsesses over door counts and valuation multiples. They stack deals without systems, celebrate growth without stability, and confuse activity with progress. Then a tenant lawsuit hits, or a market correction, or a cash crunch, and the empire built on ambition alone collapses under its own weight. Disciplined operators move differently. They build legal moats. They establish cash reserves. They automate operations before they're drowning. They know that sustainable scale requires an unshakable foundation. If your identity is tied to being a serious operator, your behavior must reflect that seriousness. Armor first, always. This is not theory, it is enforced structure. Guided plan, step-by-step, roadmap eliminates guesswork and ensures nothing critical gets skipped during implementation. Legal infrastructure, professional contract review, and entity structuring protect every transaction and eliminate hidden exposure. AI-driven accountability, automated tracking and follow-up systems ensure consistent execution without relying on memory or discipline. This isn't motivational content disguised as strategy. It's concrete infrastructure delivered through repeatable systems. The plan is structured, the legal protection is real, the AI automation is deployed. You're not left to interpret concepts, you're given the exact mechanisms that produce stability. Theory sounds impressive in presentations, but fails under operational pressure. Enforced structure survives contact with reality because it's designed for execution, not inspiration. When your foundation is built on actual systems rather than good intentions, it holds. You do not need more ambition. You need insulation. The operators who contact us really lack drive. They have vision, deal flow, and relentless work ethic. What they lack is protection from the chaos their ambition creates. More hustle without infrastructure just accelerates the path to burnout or blow up. Ambition builds. Systems preserve. Your drive gets you to 20 doors, 50 doors, 100 doors. But without stabilizing infrastructure, that portfolio becomes a liability rather than an asset. Every new property adds complexity. Every transaction multiplies exposure. Ambition without insulation is a ticking clock. The breakthrough moment happens when operators realize they don't need to want it more. They need to protect what they've built and create systems that let their ambition compound instead of consuming them. Insulation doesn't slow growth. It makes sustainable acceleration possible. If you are one disruption away from damage, you cannot ignore this. Run a simple diagnostic. If a single-tenant lawsuit, unexpected vacancy cluster, or market correction would significantly damage your operation, you're operating without adequate protection. Now that's not a judgment, it's a measurement, and measurements demand response. One legal surprise away from serious financial exposure. Unreviewed contracts create ticking time bombs. You don't know what you signed until it detonates. One cash flow disruption away from delayed obligations. Without buffer, normal business volatility forces reactive decisions that compound into bigger problems. One operational bottleneck away from losing momentum. When everything depends on you personally, growth stalls the moment you're unavailable or overwhelmed. Stability is not a reward, it is a prerequisite. You don't earn the right to protection after you've scaled. You install protection so you can scale without catastrophic risk. Ignoring foundational work doesn't make you bold, it makes you exposed. Download the 90-day cash flow stabilizer blueprint. Step 1 of preventing collapse before scale. This blueprint maps the exact infrastructure serious operators install to eliminate volatility and create sustainable growth foundations. Inside you'll find the specific systems, legal protections, and operational frameworks that transform reactive portfolios into commanded operations. This is the roadmap operators use when they're done gambling with their foundation and ready to engineer stability. The blueprint doesn't require you to slow down. It shows you how to protect what you're building while you're building it. Download it, review it, decide if engineered stability aligns with where you're headed. If it does, implementation begins immediately. You will never regret installing protection, only delaying it. Every operator who implements systematic protection reaches the same conclusion. They wish they'd done it sooner. Not because it's complicated, but because the relief is immediate and the compounding benefits are undeniable. The regret never comes from building armor. It comes from operating exposed longer than necessary, from enduring preventable chaos, from learning expensive lessons that proper infrastructure would have eliminated, from realizing that the stability you fought to create could have been engineered months or years earlier. Protection installed today prevents crisis you'll never see tomorrow. That's the nature of good infrastructure. It works invisibly until the moment you need it. Then it's everything. The operators who understand this install systems before pressure demands them. They don't wait for permission. They don't wait for perfect timing. They act. ProfitShieldGrowthSystem.com. Rise, protect, and prosper.